We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Craig Hemke from the TF Metals Report. Thanks for joining me today, Craig.
Tom, it's great to see you again.
So, Craig, recently you wrote an article called The Next Silver Price Short Squeeze, in which you walk people through the positioning of hedge funds and bank desks by looking at the commitment of traders reports. So how do these positions work? And are we seeing, a similar setup with the price being driven down here kind of in the first couple weeks of August?
Oh boy, it's going to be kind of a long answer, Tom, if that's okay.
Of course.
There's a lot to cover in trying to explain how this works. Think of it as, let me start at the beginning, I guess. We've seen all of the convictions now, the even sentencing for some of the bank traders for spoofing and manipulating price, which basically they're just doing, to make their own prop desk profits, right? Mm-hmm. So they have and especially the bullion bank desk, they know where the physical orders lie as well. They're the bullion banks are the ones that are responsible for flowing physical metal at that futures contract price. So they are always going to take positions advantageous to themselves. Mm-hmm. And when you have kind of a monopolistic control over that pricing mechanism, it's pretty hard to screw it up. And so, I think we're all, if you've been watching silver for any amount of time, and we're all familiar with the idea that at the end of a bull rush, and we haven't really had one of these for quite some time, but you get all of the hedge funds mm-hmm. and all the speculators, and everybody's on the long side. It's like everybody that's gonna buy has bought. Taking the opposite side of that trade most of the time are these bank traders who either are selling some of their accumulated positions, or they're just issuing new contracts on the short side and open interest goes way up. Then eventually what happens, like I said, everyone that has bought or is going to buy has bought. Price begins to run out of momentum. It begins to tip over to the downside, start taking out a couple of key moving averages, and then all these speculators start to rush right back out, and it's that classic stair step up and then, waterfall decline we've all gotten used to. Mm-hmm. Well, think of this short squeeze process as just the opposite. Price goes down, momentum is terrible. All these hedge funds start to get short instead. And of course, the market being the market, these bank trading desks take the opposite side and they start getting long. And it provides really kind of a floor. If you think the banks always win and, they're going to roll price over on rallies, well, they're not just then going to lose when price goes down. And we saw this on 4 occasions last year. Sentiment's terrible. The dollar index, is 114. Rates are soaring. Everybody thinks silver is just going to. I remember seeing people on Twitter saying silver was going to 12. Well, the issue was at 18, the banks were net long. And, mm-hmm. and what I mean by the banks, for people that I don't, depends on how much closely you follow this stuff, but the CFTC, the Commodity Futures Trading Commission, puts out a report every Friday that is surveyed every Tuesday. So it takes them 74 hours to come up with it. And it summarizes, doesn't give you names, but it summarizes the positions of all these different entities, these banks and the hedge funds and the like. And if you really get into the weeds, the positions are broken down to what's called swap dealers. Well, what's a swap dealer? Well, what's a swap? Well, a swap is like a derivative. What's a derivative? A futures contract or an option. Who deals them? The banks. Okay, so when you see a swap dealer category, that's the bank. So when I say the banks are short or long, that's what I'm referring to. Mm-hmm. 4 times last year, from really the end of August through December, we got to a point where these banks were net long silver's contracts from anywhere from 8,000 to 18,000. And the hedge funds, which usually drive price to the upside, were net short. Well, at that point, it's kind of a no-brainer, right? I mean, if we've seen this on the opposite direction all these times in the past, right? And then it's exactly what happened. We had 4 really dynamic short squeezes over a very quick period, like 5 or 6 days, 20% in 5 days, that sort of thing. Mm-hmm. And it's the same thing as when you get these flushes of the specs from the upside. Price all of a sudden breaks the 50-day, the machines start buying and covering, and everybody goes to lock in their gains, from being short, and you get these spikes. Anyway, point of all this is, as we record this on Friday, the 18th, there was another Commitment of Traders survey back on Tuesday. Given the way prices have gone, the banks are once again getting long, the specs are once again getting short, providing a floor for price. And if it continues, and if those positions continue to grow, we're going to get another one of these massive short squeezes. Maybe as soon as a couple of weeks from now, once we get the next jobs report, something like that.
Mm-hmm. Yeah, it's funny, as I was reading through that article, Craig, I was thinking about, the positioning and the idea that manipulation only works on the downside. It's almost like it also works on the upside in some of those cases where you have these massive entities taking these positions and, as you said, kind of controlling the market when they see fit, right?
Yeah, no doubt about it. And it continues to this day. I mean, it's something that's been prevalent. It's all part of what drove me into this 13 years ago. Yeah, I mean, anybody that watches the metals on a daily basis pretty well figures out, like I did in 2009 after about a week, and I'm like, what is this? I've been watching markets my whole life. This is not how they usually work. So that's a key to understanding. Now, some people will say, well, why do you even own metals then if these prices are so manipulated? Well, we own it because the system is so corrupt that you look at like right now, Tom, there are, after yesterday, and again, understanding that metal in the warehouse vaults can move from one, registered category to eligible, through a series of keystrokes. But after yesterday, about 3.2 million ounces of silver was moved from the registered, which basically means it's ready and available to be delivered against a delivery demand, back to eligible, leaving the registered category like 27 million ounces. Well, that's only enough physical silver, theoretically, to cover about 5,500 contracts. Mm-hmm. Well, there's 137,000 contracts, right? And so you look at that dynamic of how this price is discovered through the trading of these kind of phony baloney plastic banana futures contracts, and you think, well, eventually this is going to fall apart. So I own physical silver because of the dynamics of it. Mm-hmm. In the short term, though, if you're going to try to trade, you've got to understand these banks, silver in particular, is a little itty bitty tiny market. Mm-hmm. Very, very easy. Again, if you know where the order books are, and you know where the physical metal has to be, and you know what the producers are doing, whether they're hedging or trying to sell forward or whatever, and you know all of this, it's not very complicated to maneuver these hedge funds into positions where you can take advantage of them. Mm-hmm. And like I said, we often see it where there's a big rush of speculative interest to the long side that eventually wears out, and then it gets flushed and these waterfall declines. These short squeezes are just the opposite. They get them all into the short side, and then all of a sudden, boom, you get, $2.50 of a rally in 5 days. And that's important because, if you're an active trader, which again, I'm not, I used to be, but not anymore. But if you are, you need to be aware. You don't want to be one of these hedge funds that just, is whistling past a graveyard thinking this is a free market. Mm-hmm. That's why they keep getting tricked into falling for this. So anyway, you can use this to your advantage is what I'm saying. And if you just in the interim waiting for all of this to blow up and, whether gold and silver get remonetized and what happens to the currencies in time and all that kind of stuff. In the interim, you can trade right alongside the banks if you at least accept the fact that, what I'm discussing here is the actual reality.
Mm-hmm. Well, I think that makes it a little tough considering, as you said, this information is really so delayed, right?
Yeah. That's the thing. You can't, I don't know. There's 100 different markets, whatever they are that the CFTC keeps track of. You can get Commitment of Traders reports every Friday for all the grains, all the NYMEX stuff, all the equity futures, bond market, Forex. So they're whatever. But we're talking about the government, for God's sake, Tom. It's not like there's a shortage of government employees in Washington, D.C. They could compile this stuff. They could give you a Commitment of Traders report every morning at 8:30 if they wanted to. Mm-hmm. They just don't want to. And they have enough people that they could survey this on Tuesday and put it out on Wednesday, but they don't. They survey at the COMEX close and all the other futures market close on Tuesday. Then you get this stuff on Friday, 74 hours later. So it's not a trading tool, right?
I was going to say it's like they survey it and then they send it over by courier or maybe snail mail,
carrier pigeon,
and then they have to write it out by hand, copy it by hand.
Little pigeon flies and drops it off to a guy on a bike. Yeah, I mean, again, it's not inconceivable that they could do this in a little more timely manner. But hell, I guess we should just be glad they do anything. So anyway, I keep track of it. I keep track of it every single Friday. I write it out as a hand copy. I've got a stack of paper on my desk about 3 inches tall of these things I've been keeping track of in hard copies for about 10 years now. And where it's valuable is just on a historical basis, because you can begin to notice these trends. When positions get to X, okay, all right, now we got it. Like that other side I was talking about with the large specs. What I've done, it's a thing I came up with a decade ago. It's getting a little frothy to the upside when the amount of large speculator or hedge fund longs exceeds the amount of shorts on about a 3-to-1 or 4-to-1 basis. If they're long 100,000 contracts and short 25,000, that's a 4-to-1 ratio. That's pretty frothy. And that's just been the history of it. And then it rolls over, right? And so, what I'll do is I'll watch that. That hasn't happened now for quite a while. I mean, right now we're like at 1.3-to-1. I mean, I think it's 40,000 versus 30,000 or something like that. So, I mean, that's the flip side where it's like, oh, okay, well, now we're kind of set up, we're washed out, if you will, to rally. And then you can break down even further historically. Like I said, just go back to last year, you can find these 4 occasions where the banks, as classified by swap dealers, were suddenly, they were the ones net long 15 and 18,000 contracts, as I wrote in that article, and the hedge funds were short. And again, recognizing that, well, let's see, the last 3-4 times this has happened, maybe I can get ahead of it this time. And then what's it going to take? Like I said, you get Powell next Friday, maybe that'll do it. Maybe it's a jobs report on the 1st. And the reaction to that all of a sudden the dollar pukes a point, silver all of a sudden bumps, and it sets off this cascade of these hedge funds that are now losing money, and they're like, or they've got a small gain left, and you rush to cover, and that's more buying. And then maybe you get a technical signal that says, oh, we should go long here. Now you're buying again. And that's how those spikes happen. And eventually, like I said, if you figure the banks win almost all the time in this environment, and we're at, last fall, $18, $19 silver, currently $22, $23 silver, and the banks are long. Well, the price probably isn't going a whole lot lower, because the banks will just continue to buy, and that's going to provide a floor. And so everybody can run their numbers and count their waves and say silver is going to 12, and like last fall, and I'm like, probably not in the way this market is structured.
Yeah, that's what I was going to say. Is looking at this stuff probably provides you a good historical context and a kind of a framework to understand what happens when these positions get to where they are. But you also mentioned the dollar in there. Is this, obviously a big factor that influences not only the price of the metal, but the positioning of these big entities too.
Right, exactly. And that this current period that we're in, where gold has been down 9 days in a row and silver's been down 7 out of 9. I call it the dog days. People call it the summer doldrums. And it's this month of August is always like this. And what I mean by that is most American and Canadian traders are like, trying to squeeze in one last vacation before the kids go back to school. August, for anybody listening from Europe, everybody gets the heck out of town in August, and they take holiday, and head down, wherever, go to the coast somewhere. And so you're left with low volume, kind of light volume, and an even greater percentage of the trade every day just being these HFT trading algorithms. So they're pre-programmed to buy and sell, go long or go short based off of these signals that they're picking up. And the two main signals are what's going on in the bond market and then what's going on in the dollar. Mm-hmm. Well, for the last 2 weeks, bonds have been selling out. Hell, the yield on the 10-year note's up like 60 basis points in the last 4 weeks. The dollar index, where when we were cooking back a month ago in the middle of July and it was breaking down through 100, it's now back up over 103 and just been dripping higher every day. And so without human beings around to, kind of factor in the fundamentals of all this, the silver supply deficit, whatever, it's just the machines, and the machines on a daily basis. They see dollar go up, rates go up, and they dump whatever gold they have or silver they have, or they maybe go in short, and that's how these positions get built up. Mm-hmm. And that's why you just get this steady drip down. I posted a chart for everybody on my site yesterday of the last month, 20 days worth of trading. And I put arrows, it was 2-hour candlesticks, and I put arrows to the 6 to 8 o'clock central, which is my time zone, 2-hour candle on all of those days. And 13 of the 20 were these huge red candles, mm-hmm. All happening during COMEX hours. And it's not, oh, the banks are in there. No, really, it's just that every single day while the COMEX is open, bond market selling off and the dollar's going up and these machines are dumping. Mm-hmm. And so what I do think it's setting us up for human beings to return in 2 weeks and a shift of sentiment. I mean, sentiment couldn't be any worse, really. And probably get a pretty good rally once we get into September. Mm-hmm. And I can explain why I think that's going to happen. But again, that's what's been going on. It's no fun, but as long as you understand what it is, you can kind of deal with it.
Mm-hmm. Well, the dollar, as you were saying, last month broke below 100 on the DXY. And, for only a couple hours, not that much. Is that a very important psychological level for the dollar that is and needs to be defended?
Yes, kind of. But there's more to it than that. On the chart, I've been watching something on the chart since last year. Mm-hmm. When the dollar was going up, there was reasons for it. I'm sorry for the long answer, but there was reason for it to run into resistance at about 108. Mm-hmm. And it finally blasted through there and went to 113 or 14 in this kind of parabolic, kind of rhino horn type move. And then it came down and tried to hold 108. Last November, it broke down through 108, then tried to get back above a couple of days later, and then began a downtrend that continued until last week of lower highs and lower lows. And every time, if you could start it, you could draw a line on a chart starting from that attempt to get back over 108 in November. And it connected to about 4 straight lower highs. So there was a clear downtrend. There was also clear support at 101, come down to 101 and bounce. So in July, all of a sudden, the yen is starting to rally because of people didn't know what the Bank of Japan was going to do. And the dollar just kind of rolled over and just started to plunge and fell through 101. Selling kind of accelerated for a couple of days, got below 100, and then it stabilized. And now it has done nothing but go up ever since, as the yen has been weakening. I mean, the dollar yen's up back to 146 or something like that. And so that now it's bounced. And now it's actually, just as it broke down below 101 and was kind of a false breakdown, these last 3 or 4 days, it's broken above that trend line for the first time. Like I said, goes back to last November. Mm-hmm. Could also be a false breakout. So we'll see where that goes from here. The other thing people should watch is that dollar yen. Last October, it got up to this 145, 146 level. And the Bank of Japan intervened and started buying yen, which drove it quickly back down to 140 or 141. Now, again, think of it as the inverse. The dollar USD JPY, you'll see quoted, as it goes up, that means the yen is weakening. And as it goes down, the yen's getting stronger. So it's an inverse. So last fall, when the dollar was at 114, all of a sudden, all these other fiat, that meant they were down in the dollar index, and the yen's about 12 or 13% weighted in the dollar index. Well, the yen suddenly strengthens. That's all part of what tipped the dollar over from 114. That may help us in the days ahead too, because if this was a level the Bank of Japan wanted to defend last year, any further weakening, they may do that again. And if the dollar yen, plunges 3 or 4 points, that's going to weaken the dollar index, which may drop it back below 103 and drive it back toward 102. And the same machines that have been buying or that have been shorting and selling the metals because the dollar has been rising will all of a sudden rush to start, covering and buying. Anyway, so we got to watch that dollar index pretty closely over the next couple of days, I guess, is the short answer to what was actually about a 5-minute dissertation. Sorry, Tom.
Oh, it's all good, Craig. I mean, I was thinking at the beginning, explaining these situations for let's say newer listeners that aren't familiar with this is probably a good thing. But when we think about sentiment, maybe there are no new listeners and everybody already knows this stuff. But I think it's interesting always to kind of go through all of these different pieces of the puzzle and try to figure out where they are. I remember last year the BOJ was trying to defend, I think, the 132 level, and now they can't do that. And then they were selling USD and buying yen, right? So which is again, it's not only buying yen but selling US dollars, which has twice the effect, right?
Right, exactly. And so it's definitely going to be something to watch. I pulled up and posted on my site 2 or 3 days ago. You can go back and pull up, go to some of these places like barchart.com. You can pull up the last 40 years of the dollar yen. And this is level up here near 150. I can see why they don't want it to go past there, because on, just straight up technical analysis, you look at that and go, holy crap, it could go to 200. And again, think of that as a massive devaluation of the yen versus the dollar, where it used to be, 80 yen for a dollar, and then now it's 140. Think if it goes to 180. And, what are the impacts of that as that shakes out across, again, I mean, the impact on gold is nothing compared to what that would be across the rest of the Forex and then the global bond markets, the JGB market, the equity markets. I mean, we're all kind of, enjoying our summertime and taking a few days off. But man, I got a sneaky feeling someone's going to reach down and spin the wheel pretty fast by about the 1st or the 4th or 5th of September. And we're all going to be like, oh man, holy cow, here we go. Let's, this autumn's going to be interesting.
Yeah. I mean, thinking about the effects, let's say just on Japan as well, being such a heavy energy importer, if the value of their currency is going down that much, what does that do to their inflation numbers? And then what are the secondary impacts of what their, let's say, reaction needs to be to, again, sell more of their treasuries or whatever they're going to have to do to try to, keep that plate spinning. Right.
And I saw a chart this morning of somebody plotted dollar gold with yen gold, and again, and I think we probably all do. I get so dollar centric, right? Because that's what's quoted all over the place, the dollar reserve currency and all that kind of stuff. Oh God, gold's only, what's gold up year to date? $100. I think it finished last year, 1829. It's about that 1929, 20, whatever. It's, not keeping up with this, that, or the other thing. Well, okay, but people in Japan think it's doing just fine, or people in England think it's doing just fine. You can go to, and price it in all these other currencies, and it's doing what it's supposed to do, even in the current, pricing it through the futures contract. So that will be something to watch, though, as we get into this, as we, people start to return from vacation and everybody gets back to work in September. The other thing, too, about the Bank of Japan, remember, they went down this road of zero interest rates and yield curve control. They've been forging that path way ahead of all the other global central banks. And man, once you get on that merry-go-round, it's almost impossible to get off. And they are fighting a fight right now, trying to, okay, we'll go from 25 basis points, up to 50, for our ceiling. And, if the whole world knows that, you're stuck defending it. And I just can't imagine, given the debt structure of the U.S., with higher interest rates, the exploding cost of just interest on the national debt as a budget item every year. Tom, I saw something yesterday. The Congressional Budget Office even says that over the next decade, the U.S. is going to add almost $2 trillion a year to the total combined debt, taking it to 50 trillion plus. And whatever the tweet was said, if you do the math, that's about $5 billion a day in deficit spending and new debt. $5 billion a day. Mm-hmm. Well, where the hell's that going to come from? I mean, Powell can talk all he wants about we're not going to monetize it. Right. Okay. Where the hell's the $5 billion? Right. Mm-hmm. And once you get on that merry-go-round, like the Bank of Japan monetizing all this stuff and buying the ETFs in the stock market and trying to keep everything going, there's no getting off. Mm-hmm. And the Feds painted themselves in that same corner. They're following right down that same path.
Mm-hmm. Well, you know, you've written a little bit about that and the idea that we are already down this path. You know, how much of the Fed's debt needs to be rolled over in the near future? I think it's the next 2.5 years. And what does that mean for the deficit?
That's all. That's a little ghost in the corner that nobody wants to look at. Of the current $32 trillion, mm-hmm. That's listed, of the actual, we can talk about, unfunded liabilities and all that stuff. But you look up the national debt clock and it's 32 trillion or 33 trillion now, whatever it is. Of that, 24 trillion is in short dated maturities that are going to mature over the next 3 years. Mm-hmm. Okay. That means they're all, maybe what's the average coupon? What's the average interest at coming out of, zero interest rate policy for the last 10 years? Maybe 1.5. Powell's got the 2-year note up here now, almost at 5. So that's where when you're seeing, you go on Twitter, you read, newsletters or whatever, and you read and you see those charts of just the exploding, we'll just call it a line item of a budget, because the U.S. doesn't really have a budget anymore. Where it, used to be $500 billion a year, and they kept it in that range because, again, rates came down and the Treasury Department kept shoving everything into the shorter end where the rates were the lowest. Well, now it's time to pay the piper. Mm-hmm. And as that 24 trillion matures and gets refunded, one, you got to come up with the 24 trillion. Okay. And then it's going out now at instead of 1.5%, at 3% or 4.5%. And that $500 billion a year in interest, that doubles or triples too. Mm-hmm. And at that point, very soon here, the U.S. that's going to be behind Social Security, maybe the number one item in the budget will be interest on the debt. And you begin to just dwarf the amount of revenue that comes in. I mean, the amount of, how's the government get money? Through taxes and fees and all this other crap. Well, we're heading into a recession. Already, government tax receipts are down like 7% versus last year. So the amount of money they're bringing in is going down. The money that's going out through, the entitlements that continue to grow, but then this line item of, an extra $1 trillion a year in interest, I mean, the whole thing just begins to spiral out of control. It's what I've always called the end of the great Keynesian experiment. It's a mathematical certainty. And now, after 10 years of talking about it, we legitimately stand on the cusp of watching this whole thing finally spiral out of control.
Mm-hmm. Craig, do you think that anything the Fed does at this point is even really matters considering the magnitude of the debt? Obviously it's going to react, let's say, to a real market crash one way or another, or I imagine if we get real pain in the credit or the banking sector, they're likely going to step in. But isn't this the magnitude of debt, as you say, just kind of a mathematical certainty, and the growth of the interest on the debt is something that we're not going to be able to fix at this point?
Right. And so like next Friday, Powell's going to be at the Jackson Hole conference. Okay. Mm-hmm. And for people that don't know, that the Kansas City Fed puts on this thing in Jackson Hole, Wyoming every year. And it's August, right? So every central banker from around the world is going to, Lagarde will be there and Andy Bailey will be there. And the Japanese dude, I can't remember what his name is. It used to be Kuroda. I can't remember who it is now. But anyway, they'll all show up, do their thing. And they'll talk. And Powell will talk a good game, as he always does. Well, we're going to kill inflation, all this kind of stuff. He's been able to get away with that because of the lagging effects of interest rate hikes.
Mhm.
I saw a chart yesterday from David Rosenberg, the Canadian economist.
Yep.
Last 7 interest rate hike cycles in the US have all led to a recession going back to 1968. Now, it's just a matter of how long it takes. Might be 13 months, it might be 30 months. The average of the 7 is 22 months.
Yep.
Before you're demonstrably clear to everyone that you're in recession. All right, we're 17 months in. Rate hikes began in March of 22. Okay. I mean, you can't take mortgage rates from 3% to 7% and not have some kind of impact. You can't have credit card rates at the highest they've ever been and not have it, but it's a lagging thing. And so Powell's been able to get away with all this tough talk because of that lag.
Mhm.
I know the economy's still doing okay and unemployment rate's low and all, but it's going to catch up to him. And eventually he's going to have a choice. You're going to either have to, let rates stay at 6, 7% or whatever to try to squelch out inflation and draw down the money supply. Or you're going to have to save the banks and save the markets and save the commercial real estate and save everything. History has shown since the paradigm changed after the great financial crisis that that's the side they take to keep the plate spinning as long as possible. I don't think there's any way, especially with next year being an election year, for God's sake. I mean, he wants to keep his job. All the senators.
Which sounds crazy.
Right. When you think when's he due to go up for the Humphrey Hawkins testimony again? I guess September. All right. Or next March, he'll be up there. Every 6 months, he's got to go up before Capitol Hill to give a Humphrey Hawkins testimony. Can you imagine by March of next year, the economy, clearly now in recession, 7, 8 months out to the election? I don't know if Bernie Sanders or Elizabeth Warren, or any of these people are up for election in November. But can you imagine the rhetoric that's going to come about how you've killed the economy, you put all these people out of work, blah, 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 blah. You better start cutting rates. Mm-hmm. I mean, and then you throw on the math of it all. And where's the money going to come from to keep funding the debt, to keep it all spinning? There's just no way that they're not going to flip back and then impose their own yield curve control, go down this path that Japan's been on now for a couple of decades. I just can't imagine there's really any other way out of it because it's really the only thing they can do.
Mm-hmm. Well, you bring up the idea of mortgage rates being the highest they've been since the year 2000. And the idea of these lags, people, they see mortgage rates go from 3% to 4%. Okay, well, we can swallow that. That's not a big deal. I really want that house. I really want to upgrade, considering I did so well in the stock market over the last 2 years. And then it just seems like now we're getting to this 7-8% level. That's really going to stifle the appetite for new home sales, it would seem, right? And then all the downstream effects from that, building materials, furnishings, all of those things. That's exactly the lag effect that you're talking about, right?
Right. Exactly. Now, there's 2 things there. One, I can quote this guy. I just saw it yesterday and talked about it in my podcast. Go back 3 years ago, the median home price was like $290,000, and the average 30-year mortgage was just under 3%. Mm-hmm. You go fast forward now 3 years, the median home price is $400,000. And mortgage rates over 7%. Your down payment, if your 20% down payment has now gone up by $25,000, and your payment's gone from $1,000 a month to like $2,100 a month. Mm-hmm. Okay, that's not a tenable situation. Further, you see me sitting here in my office. I got light coming in from the sun through my office window. I'm doing this in my house. Mm-hmm. I refinanced my house one last time almost exactly 2 years ago at 2 7/8%. I'm not selling this house. Mm-hmm. Why in the world would I sell this house? So I can then, unless I'm stroking a check and paying cash for my next one, why would I let the bank off the hook, right, for my 2 7/8% mortgage? But I'm going to get far less house for the same mortgage. And that is universal. That is across the board. So there's been a very sharp drop off in existing homes for sale. So what's happening? Home builders are building homes like crazy. We just got the latest new home building permits and new housing starts this week. what they are doing is trying to provide supply into the market because existing homes aren't for sale.
Mm-hmm.
All right. What you're doing is you're bringing supply forward. Okay. What should have been homes that should have been built a year or two from now to keep that curve, that demand kind of steady for copper and wood and, washing machines and everything else. Mm-hmm. You're bringing that all forward to now. This is going to exacerbate the decline then when this happens, when all of a sudden mortgage rates come down, right? And housing prices come down. All of a sudden people with existing homes go, ooh, maybe I ought to sell. Now there's a glut of existing homes and a glut of brand new homes. And that's going to make that little section of the economy that much even worse. So what appears, again, for Powell and political economists, which I mean are economists that have a political axe to grind, right? They sit there and say, oh, look how great things are. Oh my gosh. Missing the fact that all of this stuff lags and it's all going to have to pay the piper. This idea, I've heard it, been doing this for 35 freaking years since I got out of college, right? I've heard it so many times about soft landing. In fact, there's not even going to be a landing, Tom. The plane's just going to buzz the field and keep on going, right? Yeah. And I remember 1990 hearing that, Tom, and looking at my brother and going, what does this even mean? And he had to explain it to me. One more, I saw this week. Since Google came into existence, whatever it is, 20 years ago, in 2000 and again in 2008, and you can even see this uptick in 2018, the amount of Google searches for the term soft landing starts to peak. Mm-hmm. I mean, it was a fascinating chart right before the recession because everybody's waiting for the recession. Where's the recession? They forget about the lagging effects. And right before it hits, you start thinking, oh,
must be a soft landing.
Yeah. And it's just the same thing as it's always been.
Mm-hmm. To your point about you're locking in your mortgage at 2 7/8 there. I've talked about this a couple times on the show, but I don't know if you've seen it in Canada. And I think in Australia too, there's a couple different countries that have variable rate mortgages that follow the prime interest rate.
Yeah.
So in Canada, instead of adjusting your monthly payment, they've gone to adjusting your payback period, right? So now there's something like 70 and 80-year mortgages because of the rise in interest rates. And I don't understand, when that shit hits the fan, that's going to be just insane. How are people supposed to pay for a house over 80 years? They don't have that much, productivity in their life.
Right. Sounds like another scheme rigged by the banks to their benefit, perhaps. The bank ultimately becomes the owner of that house, right? If you walk away and give them the keys and then they hope for the bounce. I don't know. It's like isn't there 100-year Swiss bond or Austrian bond or something like that out there that you can buy? I mean, wow. That sounds like the type of mortgage I wouldn't want to have. That's brutal.
Yeah. Craig, one of the last points I wanted to hit with you is kind of something that you brought up earlier is the structural deficit of silver. We're seeing this as well in copper right now. We've seen this major drawdown in global inventories. And, you put a chart up the other day of its correlation to silver. Is this another one of these kind of, loose indicators that we can be looking at when considering the movements of the metals?
Yeah, it's something I've been watching all year. And again, it's maddening, right? You mentioned silver, and we talk about what the Silver Institute say, 237 million ounce supply deficit last year, right? Mm-hmm. And you think, well, surely, and you look at gold and you hear about all this central bank gold demand. And you think, well, surely this has to have some physical demand, has to have some impact on price. Well, in the current structure, what moves price are the futures contracts. And so really it's the supply and the demand of the futures contracts more than anything else. And as long as the banks, those bullion banks can flow metal primarily through London at that price, then it all kind of keeps working. Mm-hmm. I remember seeing earlier this year, even Goldman Sachs put out a thing that they thought the global copper stockpile could be exhausted. Above ground copper could be exhausted by August. Checks watch. Isn't it August? Right? So, okay, maybe that drawdown's been a little slower than usual because, China's economy or whatever. But you would think this would have an impact sometime soon. And yet copper got up to $4 a pound a couple of weeks ago, and all of a sudden, because the dollar went up, it's just gone back down to 370 or 380. If, when, whatever, copper starts rolling to the upside again, and gets above 4, another 10% above there, we start talking 440 and 450, and the thing could feed on itself. It could do it like what nickel did a couple of years ago. The relationship to copper and silver, again, is kind of dollar based, but nonetheless, anybody can plot the two of them together over the last 20 years and kind of see them. They're not tick for tick, and the scales, they don't just lay right on top of each other, but you can see them kind of tracking each other. And right now, silver is on that historical basis seems to be pretty undervalued versus copper when you plot them together. So we'll see. Again, like I said, I would have thought if this physical situation, these dwindling global stockpiles, and again, you may have seen the charts, Tom. I mean,
yep.
It used to be 1 million pounds of it, or whatever it is, tons, in all the different global stockpiles, and now it's down to 200,000. And you think, okay, I can see where this is, but certainly has an impact on price. I don't know. I keep referencing that I think things are going to change in September, and I just, one last point I want to make sure everybody's aware of. The jobs report in the U.S. Unemployment is like the ultimate lagging indicator. It seems like every economist seems to say that, because businesses continue to hire. They think it's okay, and then finally, as the recession kicks in, they start going, "No, we better lay some people off or make some changes, and tighten our belt a little bit." I think most folks know the jobs report, the total amount of new jobs reported on that first Friday of every month, had beaten expectations something like 14 months in a row. And then they're all revised. Every single jobs number so far this year has then been revised lower in the months that follow. Well, let's see. That's from the Bureau of Labor Statistics. That's a government agency. We know 90% of the government bureaucrats in Washington, D.C. are registered Democrats. Could they be cooking the books? Maybe. I don't know. Nonetheless, market reacts to the headline number. It gets massaged, back down 50, 60,000 jobs a month later. Nobody cares. Okay. The next jobs report for the U.S. is due 2 weeks from today, on the 1st of September, right before Labor Day. Okay. The next one will be 5 months after that, first Friday of October. Okay. What we'll get on the 1st of September is the August jobs report. Now, wait a second. It's the 1st of September, Tom. How do they know what happened in August? It's the first day of the month, for God's sake. Well, it's all just guesswork, seasonal adjustments. Here's what happened previous August. We call a few people, see what they think, and it's all just a big guess. Part of that guesswork is something called a birth-death adjustment. It's not people being born and dying. It's businesses being born and dying. And the net impact on total jobs over the course of that month of, more businesses started than more businesses went out of business, the net impact of 100,000 jobs or something. And think of it like a moving average. Over the last 20 Augusts, it has been X number of jobs. So we're going to assume that this August was a lot like that. And we're going to use the same number as a guess. Okay. If you just look at that birth death thing and the history of it from last year, it gives you a pretty good idea of what that number is going to be this year, right? That would make sense. And it has been. So when all these months when it was beating expectations, it's because, these 300,000, 200,000 jobs that were created just by this guess that's how it's worked in years before. So I'm sure that's how it's working now. Okay. That first miss, first time in 14 months in the June report, was because that June was the first month seasonally every year that the birth death adjustment's pretty small. Last month, it was also kind of a miss. What we got, I guess we should say earlier this month, 3 weeks ago for July, because it was back up to being a big number. All right, long answer. What I'm getting at here. For August of last year, it's like 100,000. Hard 80,000. It was something that's a small number. I can't remember. I'd have to minimize my screen and find it for you. So there's a pretty good chance that the jobs report we get 2 weeks from today is going to be under expectations. Okay. Like 110,000 or something total jobs. And the unemployment rate's going to tick up. And people are like, whoa, they're definitely not going to be a rate hike in September now. And the narrative is going to start to shift. We're going to deal with everything else that happens in September. And by the time we get to the first Friday of October and the September jobs report, September last year on this birth death adjustment was like negative 150,000. So what I'm guessing is that the first Friday of October, after we get all this worry about, well, maybe we're starting to know, maybe it's not going to be a buzz the field. Soft landing. By the time we get to that October, first Friday of October, the September jobs report, that might print negative. Total jobs, maybe. The U.S. economy lost 25,000 jobs in September. And we are going to go from Fed not, the narrative is going to shift from the Fed keeping rates higher to they may have to cut maybe as soon as December. If I'm right about all this, then current gold price during this dog days and doldrums is seeing this current low. We'll start trending higher through September, and then into October and November, we got a chance to have a pretty good rally. Then you put it all back together with COT reports and everything else, you can kind of see this coming, I think.
And I think to your point too, the market isn't expecting any more rate hikes for this cycle, right?
Well, yeah, they're already pricing in no more rate hikes. The Fed themselves, every quarter, March, June, September, and December, they put out their summary of economic projections where all the goons that are sitting around the table say, well, I think employment rate's going to go to this. And they summarize it all and they say, well, here's what we think. At the most recent one in June, the Fed themselves was projecting 4 rate cuts next year and 5 rate cuts in 25. Okay. Now they may massage that at the September FOMC meeting. We'll see. But even they are projecting rate cuts. And what if, again, first Friday of October, we get a negative print on the jobs report and the unemployment rate ticks up 2 or 3, ticks to near 4%. Think the dollar's still going to be at 103? You think the 10-year note's still going to be 430? Probably not. Rate cut expectations start to creep in and that curve starts to move a little bit. I'm trying to get out of the sun here. I can kind of see how this whole thing could shift over the next 6 weeks. And again, factoring in what we discussed at the beginning of this call about the COT report and the positioning, you get a sharp move off the bottom and then you start taking out moving averages to the upside. The whole narrative changes again. And all of a sudden, maybe by the next time you and I talk, it's a whole different picture than what we're looking at here on the 18th of August.
Well, Craig, I appreciate you highlighting all of these factors to kind of look forward to here. It's going to be, I think, as you've written, I completely agree with you. I think it's going to be a really exciting and volatile last third of the year here. And I appreciate you walking us through it.
Always fun to talk to you, Tom. It's as boring as it seems to be right here in August. Man, I think you come back to work after Labor Day and it's going to be time to put on your helmet. There's a lot of unknown unknowns, as they say, that are coming over around the bend. And it's going to be an interesting back third of the year. Yeah,
absolutely. Of course, on Twitter, TF Metals, tfmetalsreport.com. And you're also a regular contributor to Sprott Money, right?
Yeah, they asked me to write a public article every week for them. So, because most everything else I do is on my site, and it's $15 a month to be a part of the community. But I write a public article every week that Sprott Money puts out and tweets it and that kind of stuff. And TF Metals, at TF Metals, is my, I don't know, there's 60 some odd thousand, which is still, I don't know, fill a football stadium with all the bots and the actual people that follow me on Twitter. It's still mind blowing. But that's pretty easy too. And I know it's boring, and this has been a very frustrating year, fits and starts and looking good, then it's not. But if I'm right about where all this is headed and the Fed shifting policy again, when the Fed starts to cut and when everybody knows that they're cutting, that's generally when the metals start to rally, whether that's 2010, whether that's the first part of 2016 when they stopped hiking, whether it's, the summer of 2018 all the way into 19, whether it's the reaction to COVID in March of 2020, when everybody knows the Fed has shifted toward cutting, that's when the metals go. And, the funds start buying again, people start getting interested. They start buying the GLD, they call their stockbroker wanting to buy a gold miner. we're on the cusp of that. And so we're just paying the price now by having to wait. But I sure hope everybody hangs in there.
Yeah, absolutely. Well, Craig, I appreciate you giving us some perspective on why we should hang in there.
Obviously, yeah. And we'll see what we can do, and we'll let's talk again in about 90 days or 60 days, Tom. We'll see where we stand. I think it'll be a little different look than we have now.
Absolutely, Craig. Thanks so much for your time today.
You got it, my friend. Good to see you.
Good to see you too. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.